good morning, good afternoon, maybe even good evening from wherever you're joining. Welcome to this YCharts Economic Update, which is a closer look at our Q3 2023 Econ deck, which is a summary deck that we publish every quarter and we have available on our site for YCharts users. My name is Joe Clevin. I'm a senior marketing analyst here at YCharts, and I am joined for the second time in a row by my colleague and good friend, Mr. Tom Joyce, who is one of our customer success managers here at YCharts. Tom, how are you doing today, sir?
I'm good, Joe. Thanks for having me back. I must have done something right. So I'm looking forward to dissecting Q3 with you.
Excellent. Well, good to have you side by side with me as always for, again, the second time in a row. So as we do every quarter, today we are reviewing our latest economic update deck with visuals and data that are summarizing Q3 of 2023. And our hope is that this data can help you navigate whatever is in store for the rest of the year and beyond as we approach the end of another year already into 2024. So as for you clients out there, we thank you as always for your business to YCharts, and to access the deck. If you want to log into YCharts, you can access the economic summary deck by hovering over support and going to insights and visuals. Then here in the sidebar, just clicking the economic summary deck, and we have the whole historical library here at your disposal. We've simplified our support page here so you can find what you're looking for a lot more easily and quicker. And we also have these presentations, including the monthly market wrap, as well as some of our original research pieces in PDF format. So if PowerPoint you can have as well, but in addition to that, we also have PDF, which you can keep in your Chrome browser and more accessibly get into the tool to recreate some of the charts that we have in store for you today. In addition, over support, we will have for a limited time the Q3 economic summary deck over here on the right-hand sidebar as part of our featured content, another new addition that we've made to the support tab here. So if you just simply click the Q3 deck, that'll download right here to your Chrome browser or whatever you might be using for easy accessibility. One other thing I want to highlight real quick is if you are not a YCharts client yet, you can download a free version of the deck by going to our blog and submitting your email. And that free version of the economic summary slide deck will hit your inbox shortly. Though if you do want access to the full deck, we highly encourage you to at least start a 7-day free trial here at YCharts and explore the possibility of becoming a client of ours. We'd love to have you on board. And I guess I did lie a little bit. I have one more thing to show as well. Last thing here is for the report builder tool. We now have the ability to create the economic summary slide deck as a report builder template, as a presentation slide deck here. So if you just hop over to report templates, click create new, go to presentation, and click that quarterly economic update slide deck option there, the entire economic update Q3 2023 slide deck will populate here, which you can then save to your account and then generate for the use of your clients, which can then come with your firm branding, your firm logo, custom color scheme for the client name or for whoever you might be addressing it to. A lot of personalization features as well here, but that whole deck is recreated here on the templates of Report Builder for your convenience. If PowerPoint and PDF weren't enough, you can definitely make your own here, as well as add any other charts, tables, scatter plots, you name it, even custom disclosures. Simply with the drag and drop tool, you can pop those in there and save it for your own use. So with that, just one last housekeeping item here. Just keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Nearly all the data we're reviewing today was published by various private and government agencies, and data is as of the end of Q3. September 30th of 2023, or whatever the latest data was available for particular indicators. We will be emailing a recording of today's webinar and a copy of the deck to all attendees. You can expect that in your inbox tomorrow, and this recording will also be available as a replay on our YouTube channel. So remember to like and subscribe so you don't miss out on any of our newly released videos covering webinars like this one, also with top names in the industry, all the way to helpful support videos to get you up and running with YCharts and a lot of things in between as well. With all that said, that is enough for me, and let's pass it off to Tom to get us started with the meat of the presentation. Tom, take it away for us.
Yeah, thanks, Joe. Happy to. So initially here, we're going to take a look at some market data, and we've got key stock market index performance. You can see the charts on the left and the table on the right. We were down across the board in Q3. You can see the Dow Jones, the S&P, and the NASDAQ for our US markets were down 2.10, 3.27, and 3.94% respectively. Now on the chart on the left, it's actually pretty interesting. You can see that our July actually started quite strong. August, brought us back to neutral, and then we had a sharper decline in September. So it was a volatile month or volatile quarter in terms of performance. And the same can be said for the global markets when it came to the emerging markets, World Index ex-US, and the EFA. Those were down 2.79 and then further than 4% for the World ex-US and EFA respectively. As for sectors, unfortunately, much of the same can be said. So we've got the chart on the left showing the variety of sectors, and we can clearly see one sector that outperformed the rest, and that would be the energy sector. On the right-hand side, we have the tables split out into sensitive, defensive, and cyclical sectors, respectively. In the sensitive sectors, we had two positive gainers, the energy sector as well as the communication services sector. The rest were down. In the defensive sectors, utilities and real estate brought us down respectively 9.22 and 8.88%. Part of the reason that the energy sector was increasing so hot in Q3 was due to the increase of the WTI price per barrel, which increased north of 25% in the quarter.
Certainly a volatile quarter indeed. Well, thank you for the high-level performance, Tom. Let's take a look a bit deeper here at some asset class performance, looking at year-to-date, as short as 1 month for the last quarter, and as long as 10 years ago with a 10-year look back. This table is showing the performance of these key asset classes, and U.S. growth and the S&P 500 continue to be top performers year-to-date, despite having taken 3% hits in Q3. The only leader in the 3-month column, which was covering Q3, was commodities. Those higher oil prices helped vault commodities 16% higher, largely in part to WTI breaching a key level of $90 per barrel and Brent gaining some steam across Q3 as well. Commodities was the only positive asset class in Q3. Emerging markets minus 2.8% performance was good enough to be the second best performing asset class on this table. And at the bottom was US real estate with an 8.6% decline. You'll also notice that US real estate has been toward the bottom of the barrel, and for the last 6 months, as well as year to date, has been the caboose for these asset classes, down 4.9% year to date and 8.6% over this quarter, as well as down 6.3% for the last 2 quarters combined. And with a similar matrix here, we're looking at the asset class performance on a quarter by quarter basis. So again, some similar data here. We see that with those higher commodity prices that helped vault commodities from worst to first, from worst in Q1 and Q2 of this year to best or first in Q3, which is the quarter that just ended, both emerging markets and world ex-USA broke a three-quarter winning streak, while fixed income asset classes such as US Treasuries and aggregate bonds were negative for the second straight quarter, which is a trend that we've been seeing as early as 2022 when we saw the 60-40 with stocks and bonds both falling. A lot of spillover here into 2023 with some volatile movements among asset classes.
Yeah, you certainly didn't see any consistency there in terms of the colors on the same row. All right, now we're on to performance of diversified portfolios, and this is one of my favorite charts because you're able to take a look at blends among asset classes, and we're looking at the trailing 12 months here. So over the last year, what the performance has looked like. So the top is going to be percent change since 12 months ago. And at the bottom, we're going to look at drawdowns. So at the top, we've got the S&P 500 in brighter green, and then the bottom line of that top chart is going to be a conservative 2080 model. So you're able to see, using a more equity-focused portfolio over the last year, we'd have some strong returns. With that said, at the bottom, we are showing what pullback looks like. So as we go through the ebbs and flows of the market, how does that affect a diversified portfolio? So in our chart at the bottom, again, which is showing drawdowns over the last year, we can see in purple, which is the bottom line, those are the drawdowns of the S&P 500, whereas in green, we're down about 3.37% when it comes to a conservative model. So we can see that, despite the effects of the bond market, which have been kind of taking hold over the last 18 months to 2 years, you're able to see still having those holdings and blending them together can help mitigate the risk or mitigate the volatility that is for any particular client. And then on the right-hand side, you're able to see, for those referencing this slide deck thereafter, you're able to see what the actual holdings are. But certainly a great chart to be able to explain to clients what diversification can do for a portfolio or for any given client.
Indeed it is, Tom. Indeed it is. And for those at home watching, you do see those holdings that we use to calculate these portfolios there on the right. If you'd like to create these on your own, I would say just take a screenshot of this or reference the slide deck if you have it, and then simply build that into your model portfolios within the tool. One thing I will highlight is that if you do want to build those out, you just simply have to go hover over tools and click portfolios. And it's as simple as just adding in a new model portfolio and popping those holdings in there. If you'd like to be a little bit more out of the gate here, what we can do is I'd like to share is we do have these public portfolios available on the tool, which can help you get started just a bit quicker. These are available to all YCharts users via public portfolios and are SPY Bloomberg aggregate bonds. So 80% SPY, 20% Bloomberg aggregate bonds here in this case. We also have them for 60-40, as you see here, 40-60, as you may have saw down there at the bottom, and 20-80. You can also add on the S&P 500 total return to more or less create that chart that we just saw there a second ago, hit normalized percent change, and you've got those portfolios pretty much like you just saw in the last slide, but with a little bit of holding differences. And simply clicking percent off high will then flip it on its head, and you'll be able to see drawdowns over the time frame of your choosing. And here at the top, you can select, as we have 1 year, you can go year to date, maybe for a longer look back, 5 years, whatever kind of hits your fancy, we have that available for you. So just a quick demo there for anyone at home looking to retell this story to their clients. These public portfolios are a great way to get set up and save some time creating the portfolios and get to sharing communications faster.
Yeah, couldn't have said it any better, especially with how prevalent that conversation is. Being able to do it so quickly, like you just did, using those public portfolios to your advantage within YCharts that took you a grand total of 90 seconds. Definitely something our clients like to take advantage of. So thanks for pointing that out. All right, cool. On to bonds and interest rates. So we're looking at our interest rate summary. So we've taken a look at this slide before. On the left-hand side, we have a data table of rates, and on the right-hand side, we have the yield curve. So rates seem to be all the talk, at least over the last month, if not the last quarter, Q3. And we can see that across the board, we were up. Treasuries, high yield, corporate debt, all of those rates increased. One interesting one is the 10-year settled at 4.59% as of the end of Q3. So obviously that has changed over the course of the last month, but you can see just how, knowing what we know about now about the 10-year, you can see just the difference between a 4.59% ending of Q3 and where that rests today. And then on the right-hand side, we have that yield curve. And we're able to see past the point of inversion, we're still flattening out. So, not too different from what we've seen in the past. The spread inversion has become less severe than what it was a quarter ago, but we're still seeing that severe. We're still seeing that flattening out past the point of inversion.
That's right, we are, Thomas. So it's still inverted territory, but this next slide will actually cover how that 10-2 yield spread has done over the last quarter and a little while ago with this heat map of leading indicator data and trends. So this heat map is of various economic data points, which are considered leading indicators, and it shows their trends over time. These first 4 columns here on the left are showing a quarter by quarter change, and the following 12 columns are showing those indicators on an annual basis of change. So looking here at the top on that topic of the yield curve, the 10-2 spread reached the most inverted level it had in 40 years last quarter on July 1st. Since then, that has normalized quite significantly. It is still inverted by 44 basis points, but we are seeing some return to normal there in the yield curve as it did come off of that low and end Q3 at 44 basis points underwater. Consumer sentiment rose by 3.7 points in a string of good news, as well as retail sales year over year growing 3%. The Philly Fed Manufacturing Activity Index and the NY Fed's current business activity both improved in Q3, but unfortunately are still negative and have been for at least the last 4 quarters. The last time it was positive, actually, or had a higher rate of change, was back in 2021 for the Philly Fed and the New York Fed both. And both building permits and housing starts are also in that kind of bad news category. Both have now fell in each of the last 4 quarters, showing a potential slowdown there in the housing market, which we will cover in just a couple slides in further detail. Now, moving on to trade balance, this slide and the next shows the trade activity between the USA and other key partners through Q2 of 2023, which is the latest data currently available. The chart here shows a slowdown in both US imports and exports. We see that overall imports fell 2.3% quarter over quarter, while total exports declined by 2.9% quarter over quarter. The chart on the bottom shows the actual balance of trade, which fell further into deficit. That was by a rate of 0.8% quarter over quarter. And for those of you following along with the PowerPoint version of the deck, we have this table on the same slide, but broke it up into 2 slides here for the presentation, just so it's a bit easier to see for those of you at home. And this table is showing changes in imports and exports between the US and key trade partners. Overall, quarter over quarter exports decreased the least, with Canada and the European Union, who are both tied with a 1.9% decrease. And they decreased the most with China. They were down between the US and China at an 8.9% clip. The overall decrease was mainly due to slowing goods exports, as services imports actually increased with all 4 trade partners on this table, both quarter over quarter and year over year. In terms of imports, it decreased the least with Mexico, which was down 1.9% as well. Seems to be kind of a magic number here amongst trade partners in Q3. But they did decline the most with our neighbor to the north, that being Canada. With China, one thing of note to call out is year over year goods and services imports plummeted 22% and 25% respectively, given that the only bright spot in trade with China there was services exports being up 6% quarter over quarter and up 8% year over year. But the same can't really be said for good exports and really anything that has to do with imports, especially on a year over year basis.
Yeah. Very interesting. Pivoting here to everyone's favorite topic right now, anyway, housing. So these next 3 slides, we'll be taking a look at some housing market data. And so we'll start with a data table here, and then we'll get to the charts. But a couple interesting data points to call out. So in terms of how to kind of understand and interpret this data, you can see the last release date is one column, how often that data is reported is a column as well, and then the current value. And then you can look at a 1 month change, a 3 month change, and a 1 year change. So starting in the middle column on a quarter by quarter, quarter over quarter basis, we can see some of the interesting data points of the Case-Shiller home price index actually increasing. And that's par for the course these days when it comes to homes. But we can see that housing starts and new single family houses sold, as well as pending home sales index, all decreased. One interesting figure is that I have been taking a look at is that 1 year ago column is showing us nearly 20% drop in the US pending home sales index. So at negative 18.69%, that's quite the drop over the last year. The 30-year mortgage rate is exactly what I wanted to get here too. No, Joe, you're right on cue. So you read my mind. So the 30-year mortgage rate, very interesting. This is taking a look. We're taking a look at the trailing 10 years of data in these charts. We've got the 30-year mortgage rate, US mortgage originations, and refinancing, essentially. So the 30-year mortgage rate, as you can see on the chart, has been ever increasing over the last 2 years. And we are currently, as of the end of Q3, at that high. So you can see the high is 7.31%. That value is 7.31% to end Q3. So clearly the highest, way above our average over the last 10 years. The last time that we saw that value was December of 2000. So it's been a while since we've seen mortgage rates this high. And when you kind of extrapolate that data, it brings us to something like US mortgage originations, which has seen a steep decrease since the pandemic era influx of house buying. And we're back down to that average that we saw prior to the pandemic. So that's where mortgage originations sits currently, as well as refinancing, seeing a steady drop as well. As the lowest it's been over the last 10 years. So mortgage rates being as high as they are is really affecting the broader landscape. It's not just the mortgage rates that are super high, but that is what's impacting the rest of this data. And then lastly, so we've got some other data points here. So using the NAHB and Wells Fargo indices, you can see traffic of prospective buyers, single family homes currently, single family homes conditions in the next 6 months, and then just the US housing market in general. Now, the first thing that I see on this chart is 2 things. One, the values of which we ended at Q3 were all 50 or below. And, this is 50 is another one of those thresholds, which that is the line that's going to show us is something positive or negative. Anything 50 or below is negative. And we can see that that's where we are today in the current landscape of housing. The second thing I notice is just how volatile things have become since the pandemic era. So you can see the brisk drop that we had, the brief and brisk, I suppose, drop that we had at the pandemic, and then a sharp increase and then a sharp decrease at the beginning of 2022. And now we're just trying to find our footing again. So it's been really up and down. But coupled with what we saw previously, which was the mortgage rate, et cetera, the outlook, what we see in housing market is as not as positive as we've seen in years past. All right. And sticking with me, we'll go into US dollar strength. So certainly important economic data here, different from what we've seen in the previous slides. So we've got a chart on top, which is showing us the trailing 3 years, 36 months. And then the chart on the bottom is going to show us the trailing 12 months of the US CPI, the Dixie performance. So that's the index that tracks the dollar movement. And then the purchasing power of the dollar, of the US dollar. So in red, we've got CPI over the last 3 years has increased 18%. We've got the Dixie, the dollar, which has increased just over 13%. But because we're seeing such a high level of CPI in comparison to that movement of the US dollar, we are still seeing a pullback in the purchasing power of that US dollar at down 15.36% over the last 3 years. Same sort of idea can be said for the chart below, showing the trailing 12 months. CPI up 3.69%. So that inflation is coming down on a year-over-year basis. Not to that 2% level that the Fed is trying to get it to, but inching our way there. And then we've got the Dixie, which is down about 5%. You put that all together, we've got the purchasing power down 3.56% over the trailing 12 months. And the last slide on US dollar strength. So we've got 4 different measures here: US dollars to euro, the dollar to the British pound, dollar to the Chinese yuan, and dollar to the Japanese yen. So when it comes to the top 2 lines, top 2 charts, that is, we can see that the low actually sank in Q3. So we hit that bottom. And we've kind of had a slight bounce when it comes to the euro and the pound over the last 2 months. But in early July, you can see over the trailing 12 months, we hit that bottom. We are reverting back to that mean that we've seen over the trailing 12 months, aside from that bottom, which is good. However, we saw the strength in comparison to the yuan and the yen in terms of those highs. We can see those highs have been reached really over the last month, persistently over the last 6 to 7 weeks, but at least in that top chart. But in the bottom chart, we are still seeing highs really nearing that 149.82 mark that we saw about a year ago. We're breaching that again.
Interesting you point out these exchange rates, Tom, because last time we were on 3 months ago, we were seeing some highs in the yuan and the yen, and now we've even seen higher highs.
Yeah.
And I had made a point that if the Far East was on your travel list for last quarter, now it's even an even better time to take those exchange rates. So if Japan or China is on the wish list, places to visit, no time like the present, I would say, especially with those exchange rates.
Yeah, it's like it's tough to predict, right? You think that was a better time, and then it just kept getting better.
It really did. We're seeing some strengthening in Europe too, as well as the British pound. So if you want to travel across an ocean and have your dollar go far, now is a good time to do it, it seems.
That's right.
And with that, let's get into our final segment and our crowd favorite, which is our charts of the moment that are depicting the trends of the moment and what we are seeing from clients of ours, from their clients, and what is being talked about quite often in the markets these days. And before we reveal the first chart, please note that we are open for Q&As. If you have any questions about any of the charts you see, how to recreate them in your YCharts account, or even want to know what Tom and I had for lunch, please feel free to drop anything that you are wondering in the chat there, and we will be happy to get to them at the end. So with that, the Magnificent Seven, sometimes referred to as the S&P 7, this is Apple, Amazon, Alphabet, Meta Platforms, Microsoft, Nvidia, and Tesla. I believe Berkshire Hathaway has overtaken Nvidia or Tesla, I believe, as of recent market cap. But the point is that these are some of the largest, if not the largest, stocks in the S&P 500, not to mention the Nasdaq. This chart here is illustrating the S&P 500 year to date through Q3 in the yellow line, then taking an equal weight portfolio of the S&P 7 and looking at, if you just had those seven stocks that I previously mentioned, what your year-to-date returns would be if you invested in just those seven as a collective. And meanwhile, the chart that's red is showing the S&P 500 minus the Magnificent Seven. And as we can see, if you had no exposure to the Magnificent Seven, but were invested in the rest of the S&P 500, you would have gone exactly nowhere so far this year. Whereas if you invested in the S&P 7 alone, you would be up a healthy 54.6% year to date. So it's interesting to see that the S&P 7 have certainly helped bring the overall S&P 500 index up that 11.7% through the first 3 quarters of 2023 here.
Yeah, that's powerful. I would say, just on that note, Joe, my job is to work with clients each and every day, and one of the huge talking points, and you don't have to show it, but for all of our clients attending or prospects, please know that we have capability to identify if you're holding some of these securities. So we have a holdings overlap, which will look through to your funds or ETFs in a portfolio. It's really cool to be able to say, like, yeah, we do hold Apple based on the funds that we have. We have this allocation to Apple or to Tesla, et cetera. So if that's content or information that you want to see that you have clients asking about, please reach out to your account manager. They will instruct you and show you the capacity that holds.
Love it. Thanks a bunch, Tom. I know there's many people out there asking questions about these
Oh,
seven
yeah,
stocks and the effect on their portfolios and the like. So
no
please
doubt.
keep those questions here, and we're always happy to help.
No doubt. Cool. Alrighty, so now we'll take a look at the yield curve and recession probabilities. So 2 charts. We'll start with the chart on the left, which the chart on the left, the top chart, is showing you rates, various time frames ranging from 1 year, 1 month to 3 year to 30, or 2 year, I think is shown on there. And so you're able to see all of them reflected, and you can see the rise in rates, of course. And then we are using the US recession probabilities. So that's the purple part of the chart at the bottom. And it's showing you 1 year out. So that's why the chart at the bottom goes further than the chart at the top. It's because it's showing you 1 year out recession probabilities. And that is the Estrella and Michigan yield curve based recession probabilities. So it's actually using that in tandem to show those predictions. And we're seeing clearly a very high number when it comes to that recession probability 1 year out. On the right-hand side, it's the same US recession probability economic indicator, but over a different time frame. This one I think is really interesting. So that's going back to the 60s, and the gray scales on the right-hand side are all the recessions. So that includes Great Financial Crisis, .com, early 90s. You can even see the pandemic as a thin gray bar. Now, notice how what we're currently experiencing in terms of the US recession probability, we haven't seen since the 80s. Now, I don't know what that says. It doesn't feel that great, but you can see that it hasn't been that high in about 40 years. So something to take into consideration. Now, with that said, at the end of Q2, we did see a higher value. So we've pulled back a little bit. I think it was hovering around 2/3, like a 67%. But right now we're at about 56%. So we have seen some pullback quarter over quarter.
Great illustration here, Tom. And I want to pause for a quick sec, as we have had some questions come in about where can we access these charts to illustrate how the yield curve is looking in terms of recession probability and putting on the same chart, we actually have these built out within fundamental charts as templates where you can simply click a button and they'll appear just as is, like you saw it on the chart. So if you just go into fundamental charts here, click new fundamental chart, then new from template, we have a dedicated section to the econ summary deck, which is updated every quarter with the latest charts and all the ones that you've seen here. And just by scrolling down to chart of the moment right here, that's number 2 that we're on. By clicking start, you'll have that chart exactly as is, like you saw there on the slide deck. And we also have the yield curve as a standalone in the economic data section of the templates, all the way down here at US Treasury curve analysis, which by again hitting start will show you the yield curve. And from there, you can simply export this as a PNG image and embed that into a presentation, your own slide deck, if you're into that, for any kind of communication with your clients, your prospects, or your internal colleagues. You can also share directly to Twitter, which is a neat little thing to do if you consider yourself a thought leader and want to get your opinions out there on, I guess X is what it is now, but Twitter is what people seem to know it as still. But just to point out there that we have all these pre-built for YCharts clients, and they're there with basically the click of a button.
Love it. Great. Yeah. Thanks for showing that. That is a fantastic feature. And huge thanks to our team members like Joe who keep those updated for all of our clients. So absolutely take advantage of them, make your life easier, use those templated items. On to our next segment, Charge It. So this is pretty interesting data here. This is looking at a variety of different debt indicators. So on this slide alone, credit card debt, mortgage debt, auto loan debt, total household debt. And we're looking basically since 2000, just before 2000. And a few maybe unsurprising data points. We're really reaching our highs across the board. So with basically mortgage debt, which came out just a little bit, but we're at that high for auto loan debt and total household debt, as well as credit card debt. And the big number to point out here is for the first time, we did cross 1 trillion in US credit card debt. So we hadn't done that in any of the previous quarters. We've done that now. We're basically at highs across the board with a variety of debts. So something to keep in mind is that the consumer is putting it all on that plastic and hoping to pay it off at a later date. Keeping in touch with that, we've got U.S. public debt in aggregate here compared to U.S. GDP in orange. So U.S. public debt was at about 32 trillion, whereas U.S. GDP was about 27, 28 trillion. And down below, we've got that shown as a ratio. So it took a steep increase over time, especially during that pandemic. We can see that sharp increase in blue. And we've stayed at that rate. And so now we're at about 120% in terms of debt in comparison to GDP. So these figures keep climbing. No matter what type of debt it is, we're seeing it up and to the right.
A lot of debt and a lot of charging to whatever payment method it might be. Indeed,
No
Tom, well illustrated. And one other charge it that people often do at least once a week for most is at the pump, swiping that credit card at the pump. And here we're looking at oil prices, which breached some key levels in Q3, like we talked about earlier, with the commodities asset class and the energy sector being helped along by WTI and Brent crude prices. In Q3, we saw WTI eclipse that $90 level to end the quarter at $90.77 per barrel. And Brent also fell in line with that rise as well, up to $95.86 per barrel. These events helped the average US retail gas price briefly top $4 per gallon around that time. WTI breached $90 there at the end of the quarter. And as of the very end of Q3, sits at $3.96. Like we saw with the energy sector and commodities, the energy sector, as denoted here by the Spider XLE ETF, is trending upward and finished Q3 at $90.39. Not as high as it was back in 2014 with that $100 oil, which was actually brought that ETF up to over $100, but certainly making some gains here for those who are invested in XLE. One other way to look at the crude oil situation here is taking a look at the decline in the strategic petroleum reserve stocks. So we've seen that reach as high as 726 million barrels and change. The long-term average since 1982 is around 600 million. Now, as of the end of Q3, we're seeing the strategic petroleum reserve stocks sitting at only 351 or so million barrels of oil. That represents a 45% plummet since the end of 2020, and this does currently sit at a 40-year low. Will oil, gas, and energy stock prices keep soaring higher as a result? A little sneak preview here as we put together our monthly market wrap, which you can also check out on YCharts.com, which is our monthly market review. We did see that they actually did take a little bit of a breather in contrast to what this data might suggest. Average retail gas price ended October at $3.60, which was a decline of 36 cents on average. And WTI and Brent were both down more than 5% in the month of October. So we'll see if there are long-term repercussions for because of the reserve stocks here, or if there might be more pain at the pump inbound down the road. And finally, looking at the employment picture. So we see here the US labor force participation rate is only 0.6 of a percentage point away from fully recovering to that pre-pandemic high set in February 2020. That was 63.4%. Not the highest it's ever been here in this 23-ish year view, but certainly was on the up and up there in the back half of the 2010s and is close to re-recovering to its pre-pandemic high. We also see that there are job openings still out there. Jobs are still available, but not as much as that staggering 12 million figure that occurred just a year and change ago. We do see that these job openings are currently 20% below that record high, which was set in March of 2022. And coupled with strong payroll data, this trend might suggest that employees are returning to the workforce while employers have been succeeding in filling their open positions, as we see the US unemployment rate consistently hover below 4%, clocking in at 3.8% as of September. And for those that have gone back to work, bringing those job openings down or are staying at work, in a way, some workers are finally getting ahead, though US nominal average hourly earnings, which is at the top, have been on a decline since March of 2022, which was the same time as that 12 million record high job openings figure. We see that hourly earnings adjusted for inflation, the blue chart at the bottom, just logged its 5th consecutive monthly increase in September of 2023 to close out the quarter. So the translation of this is real hourly earnings on average have outpaced inflation each month since May, which more importantly marks a staggering turnaround in wage growth, which follows 27 consecutive year-over-year decreases that were logged prior to May. As you can see, those 25 instances were all underwater there after 2020 or so, and we've just kind of eclipsed to the better part of that chart with our area chart feature, which can illustrate that well. And as promised, that is the last chart. That will do it for us. Thank you everyone for joining, and we do have a few questions in the chat that we will go ahead and open up here. I don't know this individual's name as it comes up as anonymous attendee, but anonymous attendee, if you're out there, can I create the S&P 7 versus S&P 493 chart? The answer is yes. The way that you will want to do that is get in touch with your customer success rep, who will be able to build the necessary data into your account via the custom securities tool. That's how I created the chart in my account here to demo that, and they'd be more than happy to get you set up with that as well. And we have a second anonymous attendee who said basically the same thing, just is the S&P 7 level percent change available for us to use in reports. That will indeed be anonymous attendee number 2. If you want to get that created in your account by asking your customer success rep, they will then be able to import that or help you import that into your account, which you can then save as a chart like I did, and then just simply in the report builder, drag a fundamental chart into your report and select the S&P 7 versus 493 chart there that you just created. Bryce Wandell asks as well, can the X Magnificent 7 be viewed anywhere in YCharts other through the slide deck? Yes, indeed, Bryce. So like I just said, best to get in touch with your support rep there. They would, again, be thrilled to create that for you in your account via custom securities. And then they can have that basically be its own security, which can then be imported into fundamental charts and then created as such. Gordon Achterman says on the US dollar strength chart, the bottom left has inflation data. How is the green line calculated? Would it be possible to substitute monthly inflation data for the usual standard 12-month look back inflation number? Super question there, Gordon. So what we have here is the ICE US dollar index. That's the green line, and that's simply an indicator that's in YCharts. That is looking at the level percent change here at the top over the last 3 years and at the bottom in the last trailing 12 months. You can substitute monthly inflation data instead of that 12-month look back inflation number in your YCharts account using fundamental charts. For the purposes of this presentation, we decided to take a look at 2 look back periods here, the trailing 12 months and the 3 years, but you're more than happy, the world's kind of your oyster with YCharts, where you can create pretty much anything under the sun and be able to do that there in your account with fundamental charts. We have another anonymous attendee that says, can you provide the slides for the presentation? Yes, indeed. Anonymous attendee number 3, I believe. This will come as part of a recap in your inbox tomorrow. The deck will be available along with a replay of this presentation. So look out for that in your inbox tomorrow. Last but not least, Ms. Patricia Passon says, why not just include 7 versus 493 as a standard chart? Obviously, a lot of demand. Super question as well, Patricia. We have some tools actually in the works where we can make that a possibility. In the meantime, while our product team is working on that, the way that we can best achieve it is by uploading custom securities and then using that in fundamental charts. But this, again, we will bring that up in feedback session that we have every Thursday with the product team, who will then be able to take that and engineer it for you clients out there. And as always, we always appreciate your feedback from clients. And if you're not a client and you have feedback for us, we'll take that too. And we always center our product around the feedback that you all provide. So again, thank you for doing so. It looks like the Q&A queue is empty here, so we will conclude it there. Once again, everyone, thank you for joining, and we hope you enjoyed this review of the latest economic data, market trends, and other insights. To recap what was asked in the Q&A, we will again be sending a recording of this presentation to everyone who registered for today's call. So if you didn't happen to make it and you had friends that didn't, no worries. We'll be sending everyone who registered, including you all who stay with us here until the bitter end, a replay of this webinar. So be sure to check your email tomorrow. Like I said earlier in the presentation, to get a copy of this deck, head to support, visuals and insights here, and then economic summary deck. And you'll be able to access the full library in both PowerPoint as well as now in PDF format here. And you can also create your own customized version in Report Builder. If you happen to miss that at the intro of the presentation here, no problem. You're able to just import this. We have a template all set up for you that will import pretty much all the charts here as slides into your Report Builder presentation. And one Last, friendly compliance reminder that none of this is investment advice, and YCharts is not acting as an advising party regarding client funds in any way. So with that, Tom, as always, thank you for joining me. It was a pleasure recapping Q3's events with you. And thank you all for listening to us as we recap Q3's economic events. We'll see you in a few months' time as we recap Q4 of 2023, as well as look at the full year and what all happened in 2023 and what insights we might be able to take and implement for the new year. Thanks again, everyone, and please be sure to look out for that recap tomorrow in your inbox as well as the slide deck. I'm Joe Clevin, and this was Tom Joyce. Thank you again for joining this YCharts webinar, and we'll see you all next time.